Okay, very good. I think we're ready to go. So, good evening, everyone. My name is Sean McDermott. I'm the president of Summit Investment Advisors, and I'm a certified financial planner. And we're here to teach about how to manage your taxes all year long. And along with me here today, I have Eric Budd. Eric is a tax advisor. He's been doing taxes for over 30 years. And so if there's any detailed questions as we're going through the material, feel free to ask. And if I can't give you the answer, Eric is along to try to find or to try to answer them for you. I did ask Eric, after doing taxes for 30 years, what kind of wisdom he could share with the group tonight. And he said, well, Sean, there's basically two types of taxpayers in this country. He said there's men and there's women. So no getting out of that one.
Sean, going along with that, I have certain clients that ask me if they can claim their dog as a dependent. If you can get a social security number for the dog, you can claim it.
So 3 goals tonight. The first one, we're going to talk about how income taxes work. We will talk about tax-favored investing and saving strategies, and then we're going to talk about tax planning opportunities. And as I go through the material, feel free to ask questions as we go along, and we'll try to answer them right along. How many people in here do their own tax return? Just out of curiosity. So yeah, quite a few, a big high percentage of the group. I always love this quote by Dave Barry. It's tax time. I know this because I'm staring at this document that makes no sense to me, no matter how many beers I drink. This quote here is from Ronald Reagan. American tax definition of a taxpayer. He says that's someone who works for the federal government but doesn't have to take the civil service exam. So a lot of truth on that statement. So quite a bit of the year we're working just to pay our taxes. So now, who pays taxes in the United States? Actually, the top 25% of taxpayers pay 87% of all federal income tax. Isn't that a crazy number? Top 25%, the highest 25% taxpayers end up paying 87% of our taxes in this country. So we have a progressive tax system. The more money you make, the more you're going to pay into taxes. I looked up to find out, oftentimes you hear in the news media that half of people don't pay taxes. And I did look up the study, and the Tax Policy Center from the Brookings Institute said that it's estimated that 43% of all households do not pay any income tax, any federal income tax. However, of that 43%, it's something like 50% of them do pay federal payroll tax. So those people are working, paying into Social Security, paying into Medicare. And of course, everybody that lives in this country is probably not getting out of paying sales tax. So no matter how you spend your money, you're paying some sort of taxation, no matter which way you look at it. But the basic story is a lot of the higher income taxpayers pay quite a bit of the taxes in this country. Now the tax laws are constantly changing. It seems like every new administration that comes in, they have new ideas and new ways of raising revenue for the country. The last tax law change came in 2012, and it was called the American Tax Relief Act. The American Taxpayer Relief Act of 2012. Do you guys feel any relief that's come in the last couple of years? No, neither do I. So what the basic changes in 2012 were, number one, they raised the federal tax bracket. So it went from 25%, and now it gradually has gone all the way up to 39.6% is a top marginal rate. In addition to that, they've added a 0.9% Medicare tax and a 3.6% net investment income tax called the Obamacare tax. And so if you add in your state of Minnesota taxes, it's very easy that if you're in these higher tax brackets, you could be over 50% in state and federal taxes. And so we're here today to talk a little bit about, well, how do we get these brackets down and what can you do to protect yourself on that end of things? We're going to start off with some ways of looking at how you calculate your taxes. We'll look at the marginal tax rates, the deductions, exemptions, etc. So the basics when you're calculating income taxes would be you start off with your gross income, and your gross income would include your earned income, so that would be your wages, could be some part-time income, could be some business income. It includes your dividends, your capital gains, your pensions, if you have unemployment income coming in, pension income, and it may include your Social Security income. So for some people in here, your Social Security income benefits are being taxed. So you add all that up, that's where you come up with your gross income. From there, you can subtract out some adjustments. It could be an IRA contribution for the year, could be a contribution to a health savings account. So on the front page of your federal tax return, the top part of it is usually your gross income. The bottom part will be your adjustments. And then the bottom line on the front page of your tax return would be your adjusted gross income, or your AGI. From there, you go to the second page and you have your deductions. So the deductions, what those are would be either a standard deduction or an itemized deduction. So a standard deduction is just what they'll give every single taxpayer and every married couple filing jointly. But if you want to itemize on your taxes, you can add up your home mortgage interest, your property taxes, you can add up charitable contributions. For some people, they might have deductibility of their health insurance or maybe their long-term health care policies that they're paying for. So you add up these itemized deductions, and if it's greater than your standard deduction, you'd be able to itemize on your tax return. Another big itemized deduction would be the state income taxes that you're paying on the state side. You can itemize it on the federal side. So in the front of your, we did have some handouts tonight. The very back page in your handouts, the handouts do follow along with the slides up here if anybody wants to keep notes. It's been said the faintest of ink is better than the strongest of memory, so jot things down. If you look at this handout, it has all the different tax brackets, but on the second page of it, the back side of it, it will show you your standard deduction for a single individual is $6,300 per year. So it's on the very back page, right about here, standard deduction, single individual, $6,300 per year. And then if you're married, filing jointly, it's $12,600 each year. And so if you add up your itemized deductions and it comes to more than the $6,300 or the $12,600, then you're better off itemizing on your taxes than taking a standard deduction. Make sense? Okay. Subtracting that from your adjusted gross income, and the next thing you have would be your personal exemptions. So you count yourself as a personal exemption. If you have a spouse, that's a personal exemption. If you have a dependent living with you, that could be another personal exemption. So on this chart here, the personal exemptions are worth $4,000 per person. This is for the 2015 tax year. It's $3,900 for last tax year. So we have a different chart. If you're trying to use this for your 2014 tax return, this isn't the chart. This is for this upcoming year. If you need the 2014 numbers, we have that on our website, or I could email that to you. So if you have two exemptions and one standard deduction, how much does that add up to be? 2 times 4,000? 8,000. And the standard deduction is 12,600 plus 8,000, so $20,600 is what you would have for an exemption, or excuse me, for deductions on your federal return, and these are just kind of the standard ones. So from your adjusted gross income, subtract out your deductions. Well, everybody's going to have about 20,000 of deductions for married couples, and about half that for single taxpayers. Make sense? Okay. From here, we arrive at our taxable income. And our taxable income is found on line 43 of your tax return. So everybody should know where they're at with their taxable income, because the taxable income reveals what capital gain tax bracket you're going to be in. It'll reveal what you're going to be paying for qualified dividends on your tax return. It'll tell you if you can do an IRA contribution on your tax return. It'll also give you an idea if you have to pay tax on your Social Security benefits. So remember to look up line 43 on your tax return, because that's where it all begins. Now, if you look right next to where it has your income tax exemptions and deductions, it has the tax rate schedule. And how this works is you would have your marginal tax brackets. These are the 2014, and then here's the 2015. Let me stay at the 2015. So for single individuals, you can have income up to $9,225, and it will be in the 10% tax bracket. Once you go over $9,225, but you're below $37,450, it'll be taxed at 15%. So the first $9,200 is taxed at 10%. The next portion of your income is taxed at 15%. Once you go above that, then it starts to be taxed at 25%. So you can kind of see how it gradually goes up. So each incremental dollar over these thresholds gets taxed at a higher rate. Now, when you look at the married filing jointly, it's $18,450. Anything below that is in a 10% rate. When you're at 15%, anything below $74,900, but above $18,450 is at 15%, and so forth. So you can kind of see how we have a progressive tax system. When you're over $464,000, that's where you're in a 39.6% tax bracket. And you can find these numbers are on your handout sheet there for future reference. So what's important about this table here is that it comes in very handy for planning techniques. Just one client I worked with earlier this week, in their portfolio, they have baskets of money. So they have some money they've already paid tax on, and it happens to be some Medtronic stock that they sold. They also have a basket in their portfolio of retirement accounts. So it's IRAs, 401ks, all those tax-deferred type investments. When we're looking at their tax return, line 43, their taxable income, was at about $40,000. And so we looked at these tax charts and we said, okay, well, you could actually go all the way up to $74,900 and still be in a 15% bracket. And so how that helped us is we looked at it and we said, okay, well, you could take a capital gain on some more stock and it's taxed at 0%, which I'll show you in a minute. When you retire and you start to make withdrawals from your plans, what we'll want to do is start to take a withdrawal from your IRA account, and you'll want to take withdrawal from money you already pay tax on. Because if we could take money out of the IRAs, 401ks at a lower tax bracket, that's not such a bad deal. Because if they leave the money compound and grow and it gets to be a large sum by the time they're 70, in this case, this client had over $1 million in their nest egg in the retirement accounts. At 70 and a half, what happens? They start to force it out, the required minimum distributions. And so their required minimum distribution automatically pushed them into a higher bracket. So we just said, okay, well, go ahead and start taking some of that money out right now because it's taxed at a lower rate. Okay? So that's why it's important to know kind of where you're at with your tax bracket. There are some phase outs of your personal exemptions and your standard deductions. If your income is getting too high in any single one tax year, then you're going to start to lose your personal exemptions and your standard deductions. And we've seen quite a bit of this is going to be happening for people that have a lot of capital gain in one tax year or a lot of income in one tax year. All of a sudden you're losing all your other deductions on your tax return. So that bracket is even higher than what you ever expected. Now, capital gain and dividends have special tax treatment. And this chart here talks a little bit about it, but it doesn't break it down far enough. The capital gain assets could be, if they're held for 12 months or less, it could be a stock, it could be a property. you have a gain on it and you sell it, it's taxed at ordinary income tax rates, so there's no tax breaks on it. If you hold the asset more than 1 year, it would qualify for capital gain tax rates, and the maximum tax rate is 20%. Maximum is 20%. The only way you're going to hit that 20% maximum tax rate is if you're in a 39.6% tax bracket. And how much income do you have to get in that 39.6%? A lot, yeah, $400-some thousand for married. So for most people, you're probably not going to hit those brackets unless you have a big stock sale in 1 year. So the other brackets or the other rates on a capital gain would be if you're in a 10 or a 15% marginal tax bracket, your capital gain tax rate is 0%. No capital gains on the federal side. Once you get into a 25% federal bracket all the way to the 39% federal bracket, the capital gain tax rate is only 15%. So you're getting a pretty significant tax break on these capital gains in your portfolio. The same thing applies for the dividends in the portfolio. So if you're receiving a qualified dividend, if you're in these lower brackets, there's no federal capital gain. So when we're looking at portfolios, if I have clients that have dividends that are coming in and they're not qualified dividends, one of the things we do is say, okay, well, can we make it a qualified dividend? Because then that way the capital gain tax and qualified dividend tax rates apply, and you'll save yourself 15, 20% in taxes on that income. Another application example on this capital gain would be just going back to that earlier example. I said, okay, if we have somebody, let's say they have income of $40,000 taxable income, married couple, and we know that they can go up to about $74,000 of income on their tax return and still be at that 0% capital gain tax rate. So for a client, I might look at it year by year and I'll say, okay, your taxable income is $40,000. You could take a $34,000 capital gain this year and there's no federal tax on it. So why wouldn't you do that? So year by year, you want to be realizing these gains as long as they're at 0%. You just got to pay state of Minnesota tax on them. Make sense?
How do you look that all up?
Okay, I'll repeat that question. So the question is, when you're using mutual funds, the mutual funds, oftentimes you don't have a choice of when they're going to be paying capital gains. The dividends are a little bit easier to control because you can invest in a fund that says that they're a dividend payer. But the capital gains, the mutual funds internally, they own, could be 50 stocks, could be 300 stocks, and throughout the year they're buying and selling and buying and selling. And then toward the end of the year, they distribute that capital gain to the shareholders, and you don't know how much that distribution is going to be. Sometimes you get a surprise 1099. The solution to that is to make sure when you're investing in funds that you're using tax-efficient mutual funds. So before you invest, you can look at the Morningstar report or Lipper, and it'll tell you if it has an embedded capital gain or capital gain that hasn't been realized. Or you might just say, I'm going to use a tax-efficient fund, something that's indexed, or you know that the portfolio manager is not going to be doing a lot of turnover, and then it'll be more your choice when you realize that capital gain. So there are ways of alleviating that problem, Bill. Okay? That answer your question?
Yeah.
Any other questions on capital gains? So the important thing here is kind of know where your bracket is, and if you could take advantage of the 0% capital gain tax rate or the 0% on the qualified dividends, it's definitely worth doing so. The other thing I'll bring up here is just what Ken brought up. You're one slide ahead, and he's not even looking at his notes. It's pretty good. But the more income you have coming in, the more taxation it could be creating on your Social Security income. So when you retire and you start to get those Social Security checks coming in, oftentimes it's a surprise that you have to pay tax on your Social Security income. So you might see on your Social Security statement, say, okay, we're going to get $2,000 a month in Social Security. you collect it for your first year of retirement, and then lo and behold, you go get your taxes and you just go, well, why do I owe this extra money in tax? Well, what happened here is the government says we're going to tax your Social Security if you fall into these parameters. So these are the taxable income thresholds for Social Security benefits. If you're single, once you have $25,000 or more of taxable income, provisional income, I'll define that in a second, they'll start to tax your Social Security as ordinary income. When you're over $34,000 of provisional income, they tax 85% of your Social Security benefits as ordinary income. And you can see for married filing jointly, the thresholds are $32,000. They start to tax your Social Security. Over $44,000, 85% of your benefits are taxable. How they define that is it's called provisional income. It's a separate worksheet if you're doing this on your own. They take your wages, your pension income, your IRA income, everything that falls on the front page of your tax return, all that income coming in, they add it up, and then they take 50% of whatever you're receiving in Social Security benefits, add that on top of it. And again, if you're above these thresholds here, then your Social Security becomes a taxable event. So that's kind of like a hidden tax. You might be going, oh, well, it's 0% on the capital gain, but then it all of a sudden creates taxation of your Social Security, which is a bummer. Yeah. And when you start to draw your Social Security, they don't automatically withhold income taxes. So you sign up, and then as a taxpayer, you got to kind of know these things, because you'd have to go online and get a form and voluntarily say, okay, I want to have something withheld from my Social Security for federal taxes. Oftentimes what we're finding is when you add up your deductions and exemptions, so if you add those up, we said, most couples are going to have at least $20,000 of deducts, and a lot of times those deducts will offset the taxation of the Social Security. So just on your pension income, IRA distributions, that's where you'd want to have the taxes withheld from, and Social Security might not be necessary. This was passed in, I think it was 2002, one of the Clinton heirs for his tax savings ideas, about that year. So another tax idea for you, a tax savings idea, last year I didn't have this slide in here. I added it back in because there's a lot of people that might have appreciated stock, and where a lot of Medtronic employees are having to pay tax on their stock when the inversion goes through, basically the merger between Medtronic and Covidien. And so they have to realize or pay capital gain on all the stock that they've owned over the years that's not in a retirement plan. And so we're just trying to find tax savings ideas. This is one of them. And so how this works is you could actually, children are at a lower tax bracket. And so for somebody under age 19 or full-time students under age 24, you can see the first $1,000 of income is exempt. The next amount up to $2,100 is at a 10% tax rate. And then after that, it goes back to the parents' tax rates. It's called the kiddie tax. And for a capital gain asset, it's the capital gain tax rates, which are 0% for this individual. Plus, the state of Minnesota tax rates are very, very low, typically compared to mom and dad or their grandparents. So if you have appreciated assets like stock, and if you have grandchildren or children in your family that you're saying, hey, we're probably going to help them out some way, someplace down the road anyhow, you can gift them shares of the stock. And for example, I had clients that were giving their grandchildren 50 shares of Medtronic stock last year, and the children would pay or realize about a $2,000 capital gain at 0%. And if you did this with 5 of your children, I mean, you've probably saved yourself, could be $3,000 of taxes on that stock. So it's not too late. If people in here have stock in the Medtronic inversion that's going on, it's not too late to do that. Okay? So take this into consideration if you're trying to pass money on to future generations and save money in taxation. Now, what does your income tax return say about you? Do you really want to know? So basically, what we do with these income tax returns, or what you want to know is what bracket you're in. You want to try to know if you're having qualified dividends. You want to know if you can take capital gains at a lower or 0% tax rate. And you want to stay below the kind of the bracket creep is what we call it when you go into another bracket. So if you know, and if you're looking at your tax returns, oftentimes you could make better decisions on when to take money out of IRAs, for example. And we get calls, on a regular basis. There's a lot of people that are doing remodeling on their homes right now when times are good. A lot of folks traveling. I just had a call this week with a client that went to the boat show, and they're upgrading their boat, and they need $40,000 from their account. And I looked at it and I said, well, they want $40,000, but if they take it out of their IRA account, and that's where the money has to come from because they don't have any non-qualified money, it'll force them to pay 25% on that IRA distribution plus 8% state. And so they're losing 33% of that money. So they got to get 40, they got to take about $65,000. So that makes the boat much more expensive, doesn't it? So what we did is we looked at it and we said, well, how about you do this? Take out $10,000 this year because it's only at the 15% rate. Take out a little bit more next year. He was perfectly fine with that. He said, I'm fine. I'll take out a home equity loan any day to avoid having to pay these higher income tax rates. And interest rates are very low. So when you have bigger purchases like vehicles, boats, housing projects, oftentimes it's worth looking at, well, where should the money come from to keep, the biggest expense in investing is the middleman. The middleman is Uncle Sam or the government, right? Let's move on here. I like this quote by Jay Leno. Worried about an IRS audit? Avoid what's called a red flag. That's something the IRS will always look for. For example, say you have some money left in your bank account after paying taxes. That's a red flag. That's one of my favorites. So I got some other, I always like, I think Jay Leno is kind of retiring out right now. So Jimmy Kimmel, and Barry, listen to Jimmy Kimmel. And here's his political humor. Tax day is the day that ordinary Americans send their money to Washington, D.C., and wealthy Americans send their money to the Cayman Islands. And this one's kind of stupid, but I think it's funny. Every year I include a piece of chicken in the envelope with my taxes. Not as a bribe, just as a little treat for the guy at the IRS who opens it. Let's all do that this year. Wouldn't that be kind of funny? And he says, when it comes to taxes, there are two types of people. There are those that get it done early, also known as psychopaths, and the rest of us. So good stuff anyway. All right, let's move on here into the next section, tax-favored investing and savings. And there's basically three types of investments you can save on taxes: tax-exempt, tax-deferred, and tax-advantage. So tax-exempt would be things like your municipal bonds. The municipal bonds, you collect the interest, and typically there's no state or federal taxes on that income. Second one would be tax-exempt money market funds. We'll go in more detail on that, and then we'll talk in detail about Roth IRAs. So the tax equivalent yield, first thing you need to know, is if you know where your marginal bracket is, let's say that you're in a 25% federal and you have another 8% state of Minnesota tax. So that would be basically, let's say it's 33% tax rate. That's probably about where a lot of people are at in here. So if you are earning 3% tax-free, it's the equivalent of earning 4.48% taxable. So this is a chart on how to evaluate if a tax-free investment is as good as a taxable investment. So the tax-free municipal bonds, when you're investing in them, they're free of federal income tax and free of state and local income taxes if they're held in the state that you reside in. So if you own a Minnesota municipal bond fund, if you're a resident here, no state or federal income tax. If you own a federally tax-free fund and the bonds are all over the country and you reside in Minnesota, well, you have to pay federal income tax and you have to pay state income tax except for the bonds that are held here in Minnesota. So there might be a small percent of Minnesota bonds. Okay, so these types of funds are a little bit, they say they're sensitive to interest rate fluctuations. And what this means is, you remember the investment classes that you probably came to? I think, Scott, you probably came back in the maybe 1990 or something like that. Were you at Bethel College? Is that where you came originally, or Northwestern, possibly? So I know, Kevin, you came back years ago, Federal Cartridge, but we had a class and we talked about stocks, bonds, and et cetera, et cetera. So remember what happens if interest rates go up? Rates go up, and what goes down? Bonds. Yeah, you got that teeter-totter effect. Rates go up, bond prices go down. Where are interest rates today? Very low, historically low rates. Federal Reserve said, okay, we need to start raising rates, and they use it as a tool in the economy, so interest rates can go one direction from here, that's up. And so there's a possibility if you own muni bonds or other types of bonds, as rates start trending upward, the bond prices could go down. So these types of investments aren't as sensitive as other types of investments, but there is some price fluctuation in them. Right now, this type of bond has been very popular, especially in the state of Minnesota, because last year they raised the state income tax rate all the way to 10%. So higher income taxpayers, retirees are going, okay, we love this municipal interest because there's no state or federal income tax on it. Tax-exempt money market funds, I'm going to skip over this because there's not a very good yield on these. They're not very popular right now. And let's talk about IRA accounts. One other thing I'll mention is about taxes and tax-free states, is that some states that you reside in, you don't have to pay tax on your Social Security benefits. So here in Minnesota, when you receive your Social Security benefits, if you have provisional income, you got to pay tax on them. Other states, like Florida, you don't pay tax on your Social Security benefits. You don't pay tax on your pension. So they have no state income tax rate. They have no state capital gain tax rate. So last year I saw probably about 4 clients that actually had the flexibility and they loved, living in other states. I had 1 that moved down to Florida and 3 of them that moved down to the state of Florida, or 1 to Texas and 3 down to the state of Florida, because there's no state income tax rate. And it saves them a bundle of money during their retirement. So that happens. Now, let's talk a little bit about these IRA accounts. This is a tax-favored type of investing. The IRA, traditional IRA, you have tax-deferred accumulation. So when you put money in, it compounds and grows, and you don't pay tax on it each year. Withdrawals are taxed as ordinary income. And so when you start taking the money out at retirement, it's just taxed the way any other income would be taxed. There's no tax breaks on it. When do you have to start taking money out? 70 and a half. 70 and a half, they say, okay, you've built up this money in these retirement plans. The government wants you to start paying tax on it. And so there's a point that you do have to pay tax on it. The soonest you can take money out of an IRA account is 59 and a half. The Roth IRA, when you put money in, you don't deduct it on your taxes, but the benefit is it's tax-free growth as long as you're leaving it in there for at least 5 years, and 59 and a half. Prior to 59 and a half, you can use it for higher education or first-time home purchase. So the Roth IRA and the IRA are still, a lot of people will use these as for tax deductions. If you look at your tax charts that I handed out on the first page, pull those out for a second. You'll see in this first block right up here for retirement plan contributions, how much you can put into retirement plans. And you see at the top, for 401ks, 403b, deferred comp, you can put in $18,000 if you're age 50 or below. Over age 50, you can put in an additional $6,000 as a catch-up, so you can put away $24,000 pre-tax into a 401k for this tax year. Tony?
That's only if you have anything.
Yeah, that's correct. Let's go to the IRA here for a second. In an IRA, you can put away, right in the middle there, $5,000 pre-tax if you're under age 50, over age 50, an additional $5,500 and an additional $1,000, so up to $6,500 if you're over age 50 into an IRA or a Roth IRA. Whether it's pre-tax or after-tax depends on your income and whether or not you have an employer-sponsored plan. So first off, on these IRA contributions, you need to have earned income during that tax year. And so if you're working part-time or your spouse is working or if you're both working, you may be eligible to do a pre-tax IRA. So you might be eligible to put in $6,500. If you're not eligible for pre-tax, you probably want to look at the Roth IRA. Again, you need to have wages to do this. So Kevin, you retired last year? This year? Okay.
Well,
October of this year?
14.
14? Last year. Okay. So like Kevin, he retired last year. He had wages last year. So Kevin can put away $6,500 into a Roth IRA account. It's after tax, but it accumulates tax-free for life. He doesn't have any wages this year, so he can't put money into a Roth IRA for this tax season unless he starts working again. So if you want to make a Roth IRA contribution, you can make the contribution all the way to April 15th of this tax year. Okay? So you have a little bit of time to consider this. When you're meeting with your tax person or if you're using a tax software package, just ask if you are eligible for pre-tax or Roth IRA because they're a really good idea, great tax savings opportunity. Questions on this? Yes?
Is there any basic guideline on which one you should consider? I'm sure there is.
I think, yeah, that's a good question. Basic guidelines on which might be better, and we're getting this question quite a bit because at corporations right now, companies are allowing employees to do pre-tax 401k and Roth 401k. You guys notice that at your company, the Roth 401k? So you go, okay, well, should I do pre-tax or after-tax? Kind of our dividing line on this is that we think that if you're in a lower bracket, their 10 or the 15% marginal federal tax brackets, it's worthwhile going after tax into the Roth because then it's tax-free down the road. If you're in the 25% bracket or above, if you take that 25% plus the state of Minnesota tax, we think you're way better off going pre-tax on that money. So I recently had somebody in and the married couple, their taxable income was $100,000, and I noticed they're putting 5% of their 401k contribution into the Roth portion, and I thought that would be better, the money be better utilized putting it into pre-tax because they'd end up having 33% more money invested in that nest egg compounding forward, and that would end up to be more. Of course, hopefully they'd be in a lower bracket when they retire. So, the Roth IRA, if you have an employer-sponsored plan and you have a 401k through your job, then you probably can't do a pre-tax IRA. You probably have to use a Roth IRA. There are some upper limits as to whether or not you could do a Roth. You'll see on this chart here that if you're single, if your income is above $116,000 but below $131,000, you can still do a Roth, but it gets phased out. If you're over $131,000 of income single, you can't do a Roth IRA. And then the married filing jointly, the cutoff is $183,000, starts to phase out. $193,000, you're not eligible. Okay? There's another thing called a Roth conversion. You guys heard of these before? So how a Roth conversion works is you have this pre-tax money in these IRA accounts, and it's staying tax deferred. You might be spending it. You might have to take it out at 70 and a half. when you die, your heirs have to pay tax on it eventually. So the Roth IRA is better because it's tax-free growth and it goes to your heirs tax-free. So it's a great estate tax planning tool. So what we find is that for people in a lower bracket, so remember earlier on I was talking about 43% of people don't even pay federal tax. Oftentimes we'll run into folks, we'll look at their tax return and we notice that they have more deductions than they do income coming in because their Social Security is not being taxed. They're offsetting their pension with their deductions and they're in a very low or a negative tax bracket. And so what we'll recommend, we'll say, okay, go ahead and take money out of that IRA in a low or nil tax bracket, convert it into your Roth IRA, and then for forever on into the future, it's tax-free accumulation of your money. And then the other area that Roths come in handy is in that boat example I gave you earlier. So this individual, we looked at it and we said, well, you could pull some out of that Roth IRA and there's no tax on it. But he decided not to do that because he wants to keep it compounding for a longer period of time. All right, let's go ahead and move on. And the employer-sponsored retirement plans, again, the 401k is pre-tax, tax deferred. It helps lower your tax liability. And then there's annual contribution limits. So if you have a large capital gain, like for people that are having to realize gain on their Medtronic stock this year, this is the first thing that we say to look at is, are you maximizing your pre-tax 401k contributions? Because if you're over age 50, you can put away, what do we say, $24,000 pre-tax. And you know, for a married couple filing jointly, that's $48,000 tax deduction, and that'll definitely help offset a lot of that capital gain you might be realizing this year. So this is a great, great way of saving money. Make sense? Okay, so put away what you can into these pre-tax IRA contributions. Use the income from other sources during that year. And then eventually, you know, when you retire, you'll probably be in a lower bracket to take that money back out. Different types of annuities. Annuities are used so individuals can tax defer their money. And there's fixed annuities which pay a set interest rate. It could be anything from 2%, maybe up to 4%. The rates are fairly low these days. There's a variable annuity. The variable annuity is where you have mutual fund selections within the annuity product. So you can go for higher growth or more conservative. So it's up to you. You have flexibility. And then there's an indexed annuity. Indexed annuities are where they're marked to the stock market. So if the stock market goes up, your annuity value goes up. The index annuity, there's no downside. So if the stock market goes down, you don't lose your principal. So they're guaranteeing that you'll receive at least your principal back over a certain period of time. A couple different types of annuities. We won't go too far in depth in those. And then we have our stock examples here. So let's kind of break this down a little bit. There's tax deferred accounts and taxable accounts. In the tax deferred accounts, oftentimes we'll recommend holding capital assets that might have a lot of interest, a lot of turnover, because it doesn't matter in the tax deferred accounts because you don't have to keep paying tax on them every year. So typically you want your higher growth things in this type of account. It does have right here where it says REITs, Real Estate Investment Trust. How many people in here have a REIT? Bet you, yeah, REITs, what the tax advantage to the REIT, there's stocks, bonds, real estate. Those are the three main investments you can make money at that I know of in the United States. The REITs generally are going to have, let's just say, a 5 to 6 to maybe even a 7% dividend distribution from them, where they collect all the rents from their tenants, they pay that out in cash, typically monthly or quarterly, and then the income that you're receiving, generally about half of it, there's no tax due because they depreciate the buildings in there. So there's some tax benefits to using real estate investment trust type investments, and they're a little bit higher return than other types of investments in that area. Some of the other areas that we think are useful would be There's a tax dividend yielding stocks. Again, trying to find those qualified dividends in a portfolio is important. And one of the other investments that we've been using more often for tax advantage income would be the MLP funds that are oil and natural gas pipelines, because those are yielding 6 to 7%, and they offset the income through depreciation. So to get 6% in today's environment is not easy, and so we're always trying to find more creative ways, tax advantage ways of doing that. Okay. Additional strategies, we talked about putting capital losses to good use. So if you have assets that have gone down in value, you could sell those and then repurchase a similar asset, and then on your tax return, you could take up to whatever you have in loss to offset capital gain. If you don't have any capital gains, you could take those losses to offset ordinary income up to $3,000 per year. So that's a good deal, especially if you're in a higher bracket, and you can carry forward the losses on your tax return. So we'd still find individuals that have carry forward losses. Determine which shares to sell first. We won't get into that tonight. We're going to talk about some tax planning opportunities, and then we'll wrap it up here pretty quick. So this is a pretty simple one, pay off credit cards. If you do have debt, then the best places to have debt would be on home equity lines of credit, mortgage, because those are tax deductible interest if you're itemizing on your tax return. Things like credit cards and other car loans, you don't get any tax break on those. Tax-free exchanges, stock and bond swap and 1035 exchanges, and there's also a 1031 tax-free exchange. How these come into play is if you have an investment that's gone up in value, such as a stock or maybe an annuity, or a property that's gained in value. Let's say you have, like for example, today at the lunch meeting we had, there was somebody in the room and he has a building and he's selling the building for $150,000, and he said he's depreciated it all the way, so there's going to be $150,000 of capital gain. And so he could actually take that building and do a 1031 tax-free exchange into another business type building and not have to pay any capital gain tax on it. So if you have farmland, for example, that's appreciated, you could do a 1031 tax-free exchange into a business or another building and get income from that building, but never have to pay the government on the gain. At death, homes and stocks, farmland, those things actually step up in basis. So like if you're inheriting something that has a lot of capital gain built into it and your parents don't want to sell it, or your grandparents, when you inherit it, there's no tax on it. So it usually steps up in value. There's no federal tax unless there's, state of Minnesota death tax or estate tax. Treasury securities, there's some tax breaks there. And then let's talk a little bit about charitable contributions. The charitable contributions idea, for those people that are charitably inclined, it's a good idea to take a look at gifting appreciated investments like stock, or if you're having to do RMDs, required minimum distributions from your IRA accounts, give that to charity because it gives you more bang for the buck. I'll go through two examples. So stock, if you have an appreciated stock, and let me use 3M stock as an example. So that caught somebody's attention here. Still with us? So let's say that the stock has gone up in value and a person bought it for $20 a share, and now the stock is $100 per share. If they sell the stock and then gift the cash to charity, they'd have to sell the stock, pay tax on that $80 capital gain, and then what's left, they can go to charity and then eventually try to do an itemized deduction on it. Now, if they just took the stock shares and gifted it to charity, well, in that one stock share, they have a full market value write-off of $100, as an itemized deduction directly to the charity gets the full stock, or $100, and there's no IRS waiting there as a middleman saying, okay, we want a third of everything, okay? So it's a good idea to, if you're gifting shares, just gift them directly to charity. Don't sell the shares first, realize it in your tax bracket, and then try to gift it. The other thing that you need to take a look at is if you're working at a larger corporation, like Medtronic is a great example. If you gift shares of your stock to a nonprofit, Medtronic will actually match dollar for dollar whatever you're gifting to that nonprofit, as long as it's a 501c3 and not a religious organization. So last year I had clients that said, okay, we're planning on gifting, we've been gifting for a long time, we're going to end up owing a bunch of tax on the stock that we have to realize gains on. We'll just take the shares of stock and gift them right to the charitable organization. Medtronic matches up to $100,000 of whatever you're gifting. So they've doubled their gifts by doing that. A lot of people, what we said, because they don't match the church, what you can do is you can set up what we call a donor advised fund. It's just like a mutual fund. You can pick your investment risk, gift it to the donor advised fund. You get your dollar for dollar match from your charitable or from your corporation, and now they've, in this example, they gifted $10,000 stock. They have a $10,000 tax write-off. They got an additional $10,000 from Medtronic. They have $20,000 in that fund. They can do what they want with it from there. They can gift out growth on the fund. They can gift it all the way out once. They can gift it throughout their lifetime. So these donor advised funds for people that are charitably inclined over time, they're a really great idea. Great way of managing gifts. When you pass away, then your kids get to manage that gift and give it, to charity on a year-by-year basis. Okay, makes sense? So look at gifting highly appreciated assets, required minimum distributions, same deal. Those can go directly to charity. So you don't want to take it on your income tax return, because what happens when you get it on your income tax return? It raises your provisional income. It could raise your tax bracket. So if it's going directly to charity, then it's a bigger gift, net. Homeowners, I just want to bring this up real quick, is we see a lot of movement with our clients, with possible downsizing or going to a no snow, no mow community, maintenance free. I've had a couple calls in the last 6 months of people selling their home and looking at cooperative associations. And so the deal here is if you sell your home, if you're single, you can realize up to $250,000 a gain and there's no tax. If you're married, filing jointly, up to $500,000 of gain, no tax. And you can do this every 3 years as long as it's your primary residence. So we've had clients that have owned more than one property where they'll sell their primary residence. And I had a client that said, okay, we have this lake cabin. They made that their primary residence for 3 years, and then they sold that tax-free, because otherwise they would have had a capital gain. And so it's a way of kind of getting around having to pay capital gain tax on property sales. Talked about that already. This question here is always interesting. So what if you get audited? And the answer, if you get audited, if there's red flags on your tax return, what you want to do, I'd highly recommend contact a tax professional, somebody to help you with those questions before you respond to the IRS, unless it's something that's pretty straightforward, pretty simple. Otherwise, you could end up getting yourself into a longer conversation with that IRS agent, where we've heard of too many people that go in an audit for one item, and then they start giving too much information, and then the IRS people go, well, and they keep digging and digging, and pretty soon they want to look at all your bank records and all your tax returns, where they just wanted one thing in the first place. The state of Minnesota hired something like 300 new auditors state tax auditors in order to, again, try to find more revenue for the state. And so in tax years that you're having, for example, if you have a lot of capital gain, if you have a lot of income, then you're probably a higher likelihood that you're going to be audited that year. The other thing I'll say is that a lot of the systems that they have in place with the IRS are very automated, with their computer system. So if you miss something like a 1099, reporting something on a 1099 or miss a distribution on something, they usually can catch that because the systems are all pretty linked together these days. And that's fine, because that helps taxpayers, stay out of trouble. So to sum it up, how can you manage your taxes? Understand how income taxes work. This one here, line 43 of your tax return is kind of where it all begins. Figure out where you're at with line 43. That'll tell us your marginal income tax bracket, and that'll help you better manage your investments. Practice tax saving and investing. So make sure you're taking advantage of pre-tax investments, taking advantage of the lower capital gains and qualified dividend tax rates. Make sure if you can do a Roth IRA, do a Roth IRA because it's tax-free for life. And then utilize tax planning opportunities. Where do you go from here? If you do have questions and if you are not doing your own tax return, feel free to contact my office. We do have Eric Budd, works out of our office here. He does hundreds of tax returns for our clients every year. And the advantage of this is that a lot of the material is linked together. So if there's a 1099 or something that Eric needs, oftentimes he can ask us. If there's a capital gain, he can say, okay, Sean, what's going on with this client? On the other side of that, after Eric does the tax return, then we can see if everything's included properly, and we can start to strategize with our clients to get you in lower brackets and see if there's any other tax planning opportunities. Most tax advisors do your tax return, and that's it. They crank out the tax returns, that's their job, but they don't do tax planning. Okay, they do the returns. So if anybody's interested or has specific tax questions, Eric's here afterward to answer them, or you can email me or call me, and we'll try to help you out with that. Last quote by Dave Barry. And to you taxpayers out there, file your tax return on time. And remember that even though income taxes are a pain in the neck, the folks at the IRS are regular people just like you, except they can destroy your life. So thank you for coming. Next week, or in a couple of weeks, we're going to have our next workshop. It's going to be on Market Update 2015 Outlook for the economy. It should be a good one. And we have some other fun events coming up that we'll be announcing on our website. If you're new to here, if you have an email, or if you'd like to receive correspondence on upcoming workshops, please make sure you leave us your name. If you want to do a complimentary sit-down consultation, that is offered free of charge.